Welcome to the trading desk. Let's get right into this week's weekly market briefing. I'm Analyst A, and alongside Analyst B, we're unpacking a pretty fragile Shadow Fox market outlook today.
That's right. Look, if you're an active market operator, consider this your baseline for the week. We're cutting straight through the noise to give you the exact so what for your portfolio as we navigate this liquidity transition. Let's hit the numbers.
From a macro strategy perspective, the headline regime right now is clear. We're attempting a controlled risk on rotation, but, and it's a big but, we're dragging a really heavy late-cycle macro overhang. We're seeing equity markets trying to broaden out into cyclicals and industrials, which, hey, that is a positive sign. But they're doing this under structurally tight liquidity, seriously stretched valuations in mega-cap tech, and fiscal policy that's still unresolved. Bottom line, it's a fragile setup. A sudden shock to rates could rip out that support and throw us right back into a risk-off regime. Anchoring our risk mandate this week is an executive risk score of 63. Now, a score in the low 60s tells us we're definitely out of outright panic-driven risk-off territory. But the drawdown potential? It's meaningfully above the historical median. We've got latent policy risks and this highly concentrated leadership in AI. Simply put, the downside tails right now are defined by potential policy missteps and funding stress, not an obvious economic collapse.
Right, and I'll take the conviction score here. We're sitting at a 58. It's positive, sure, but it is highly measured. While trend and breadth have definitely bounced off their lows, the liquidity and sentiment metrics we're tracking are still incredibly inconsistent. The regime engine is basically dictating that we must favor selective participation over broad beta. This is absolutely not the time to just close your eyes and buy the index. You really need to be hunting for quality balance sheets with crystal clear cash flow visibility.
All right, moving into our first major segment, the deep dive on Treasury liquidity. Look, while everyone else is endlessly debating AI earnings, the single most consequential structural driver for your portfolio positioning right now is actually sitting over in the bond market. Tactically speaking, the absolute biggest threat is a hiccup in auction demand.
Exactly. We're talking specifically about a tail. That's when the Treasury actually has to offer a higher yield than the market expected just to get the debt off its books. It's a glaring signal of weak buyer demand, maybe a sudden drop in indirect participation from foreign central banks. And let me be clear, this is a massive bearish trigger for a liquidity shock because it means financial conditions are tightening abruptly, right in real time.
And here is exactly how that transmission mechanism hits your portfolio. Step 1, poor bid-to-cover ratios and auction tails hit the wire. Step 2, this forces term premia and real yields sharply higher. And Step 3, that spike in real yields acts as an absolute wrecking ball to the valuation multiples of long-duration assets. If your cost of capital spikes because of a Treasury tail, those high-growth AI and cloud infrastructure multiples are going to compress, and compress violently. And compounding that interest rate vulnerability is the looming threat of an AI capex air pocket. The market's current AI valuations are totally built on this assumption of relentless, sustained capital expenditure. But if we start seeing guidance cuts, delayed projects, or just a sudden pause in spending from those big infrastructure leaders, that hypersensitive momentum reverses instantly. It would completely shatter the current valuation models. It's a low to medium probability event right now, but the impact, very high.
Okay, let's pivot. Here is your tactical playbook.
So, what is the action plan for operators? We've got a stark contrast in execution depending on your time frame. For you swing traders operating on a 1 to 4 week horizon, the mandate is simple. Participate, don't chase. You can lean mildly pro-risk, but you absolutely must deploy strict downside controls. We're talking downside volatility bands and using recent swing lows as hard stop zones. On the flip side, long-term investors looking out 3 to 12 months, you need a core ballast strategy. Keep accumulating those quality franchises, for sure, but maintain a strong defensive ballast in utilities, staples, and low-beta assets. Do not get over-concentrated in crowded AI narratives.
Let's get really specific on these tactical responses. If financial conditions tighten abruptly, say we get a brutal Treasury auction, that is your bearish trigger. You need to rapidly shift to capital preservation. Trim those extended winners, dial back the leverage, and rotate into short-duration assets and utilities. Now, if we get a bullish trigger, like surprisingly strong auction demand that lowers term premia, modestly reduce your cash buffers and selectively add to your high-conviction growth names. But across the board, keep your risk controls tight, scaling gradually, and absolutely keep your dry powder dry for market dislocations.
All right, Section 3, let's map out the Catalyst watch list and our risk matrix. Pulling up the Shadow Fox risk matrix, it is critical to see where the heat is right now. Treasury liquidity and credit spread widening are both flashing elevated. They are dominating the left tail risk for us this week. hawkish repricing from the Fed is sitting on watch, and that AI CapEx air pocket we talked about is in the monitoring phase. A systemic funding freeze remains a low probability, but if it happens, the impact is very high. Long story short, the macro ice is pretty thin here.
To stay ahead of that matrix, here are the critical catalysts your eyes need to be glued to this week. Number 1, real-time Treasury and direct participation, and those bid-to-cover ratios. Number 2, Fed rate path rhetoric. We're looking for any hawkish surprises that could reprice expectations. Number 3, fundamental shifts in corporate earnings, specifically listening for any tweaks to AI CapEx guidance. And lastly, macro prints, any CPI or PPI data that disrupts our current disinflation sentiment. Any single one of these can shift our regime straight into a severe headwind.
So as an operator facing this fragile regime with a risk score of 63, you really have to ask yourself a hard question. Are you genuinely prepared for an issuance-driven shock to interest rate-sensitive sectors?
Exactly. Think about it. If a Treasury auction completely fails this afternoon and real yields suddenly spike, are your hedges accurately positioned? Have you actually trimmed your extended tech winners, or are you sitting dangerously over-concentrated in a crowded trade just waiting to face a violent multiple compression?
If you aren't 100% sure of the answer, it is time to reevaluate your exposure right now. We'll leave you with our core Shadow Fox mandate for the week. Protect capital first, opportunity follows survival. Ask yourself as you boot up your screens tomorrow morning, if the liquidity tide goes out at 1 p.m., who's left swimming naked? Trade smart out there. We'll see you next week.